Hello friends, how are you? I hope all of you are doing really good. So welcome to KSJ Teaching. I'm your friend, your mentor, CS Saurav Jindal, welcoming you all to the last session of Economics of Finance Excellency batch, the last lecture. So we are on time completion for the batch. Okay, so what we have been discussing about? We have been discussing about the international capital movements. And in that, we discussed about what is FDI, what is FPI. So I hope all of you must have revised whatever we have studied, and I told you to study the difference between FDI and FPI once, right? Now there are just small topics which are left for this particular lecture, the last lecture of this series. That the first one is the benefits of the FDI for the host country, right? For the host country, which one is the host country, sir? If Mr. X of USA wants to invest in India, India is the host country. Now just think as a layman, what can be the benefits if anyone from outside is investing in India? What can be the benefits, sir? You are getting the foreign exchange, your forex balance will improve, right? And with the investment, he will be bringing the technological upgradation and all those things. Better production will be there, the growth of the economy will be there because you are getting an investment from outside the country, right? Stimulates the growth in that case. Then technological upgradation will be there, that will help in the many other sectors of the economy. Then employment will be there, isn't it? The employment will be there because if he is investing in the form of opening an office in India, then he will employ some people from India itself, isn't it? So these are some of the common benefits. If you just as a layman also you think about it, you will get to know that what can be the benefits, right? The first one is fosters the competition. It will increase the competition with the domestic market, and the domestic market will be forced to increase their efficiency, right? Stimulates the competition and creates the competitive environment, resulting in lower cost, higher efficacy, greater variety and better quality and lower prices. Now the domestic market will also have to match their standards, match their prices. They will have to upgrade themselves, they need to provide the better products, right? Now the monopoly is not there, the domestic monopoly will not be there. Higher output, as I told you, that more number of units will be produced, the people will have more choices to select from. Stimulates the growth, stimulate growth by providing capital, technological knowledge, management skills, marketing methods and human capital skills, right? Then is promote the reforms. Promote reforms is that the host country government will have to change their policies to encourage FDI. Competition for FDI among the nation helps to promote the political reforms process in the host country. Now host country will have to change according to what is the requirement to attract FDI. Obviously, sir, every country wants that we should be getting some funds from the foreign, right? FDI, including the reforms in the legal systems and the macroeconomic policies, which will be in the favor, which will be favorable for the nation. Generates direct and indirect employment, as I told you. Benefits the workers. FDI is likely to result in relatively higher wages for the skilled jobs, and also provides employment opportunities to unskilled and less educated people. That when someone from the foreign is setting up a business, they will obviously they might be needing some skilled jobs, they might get a better wage rate than working in the domestic industry. Secure forex, that means your forex reserves will increase. Produces the goods that can be exported. Host country is able to secure the scarce foreign exchange, right? If Mr. X of USA sets up a business in India, right, and he manufactures the products and sell those products in the Europe, then what is that? The India will get benefited because where they will be getting the income, they will be generating the revenue in India, right? Then is the tax revenue. The FDI may also act as a source of the new tax revenue. Obviously, sir, whatever the income Mr. X will generate in India, he will have to pay tax in India. That will increase the tax revenue base, right? When the host country government implements effective tax measures for the purpose. Other benefit, ensure better access to the foreign market, promotes bilateral and international relationships. Obviously, greater possibility for promotion of ancillary units and able to achieve cost reduction from the economies of scale because of the greater output. The weakens the market power of the domestic monopolies, favorable impact on balance of payment position. better work culture and higher productivity standards, overall human resource development. So overall the FDI is good in these respects, right? After that, he says problems or the cost of FDI for the host country. Now, in this case, what can be the problems? Just think about it. Sir, it can badly hit the domestic industry, right? It can badly hit the domestic industry, which might not be competitive enough to, get the prices down to the imported ones, right? It might not have the technological skills. So capital intensive production, whenever the FDI is there, they will mostly focus on the capital intensive, which may hit the labor intensive market. FDI tends to implement the capital intensive production techniques. Such production methods are inappropriate for the labor abundant countries like the India, because the problem of unemployment will continue to prevail in that case, right? The labor will remain unemployed. Why? Because anyone, if Mr. X from USA wants to invest in India, he opens an office. What will be his thought process? The thought process will be that we need to, do all the particular work with the machinery. More of the capital intensive techniques will be there rather than the labor intensive techniques. So where the labor is in abundant, in a country like India where the labor is in abundant, right, how can you do the more of capital intensive production than labor? Where will the labor go, sir? How they will eat? Regional disparity and inequality. Now, what will FDI says? Mr. X wants to come invest in India. He will say that, okay, looking at all the geographical locations, I have decided I will invest in Gujarat, right? Then what will happen, sir? If Gujarat is already developed, right, and one part of the country which is not developed, and you are still investing in Gujarat, the other part will remain undeveloped, sir. This disparity will keep on increasing because you are already investing in an already developed area. What about the underdeveloped area? That will remain underdeveloped. FDI move toward the regions which are better equipped in terms of natural resources or infrastructure, and hence worsens the regional disparity. Clear? It also increases the income inequalities. Adverse impact on the domestic investment. Obviously, sir, the domestic market will be badly hit. The foreign firms sometimes finance their investment by borrowing from the host country's capital market. This can lead to higher interest rates in the host country and thereby cause the decline in the domestic investment. He says that if Mr. X comes to India, he buys the money, he raises the money from the capital market of India itself, right? Now he has that much of money that he can raise from the he can invest in the market or he can raise from the market. He has that much of the resources, right, which may lead to increase in the interest rates. Adverse balance of payment effect, because whatever they are earning, they will be sending back to their country. Mr. X comes to India, invest in India, they earn in India, they send back the money to USA. Okay? Although FDI brings forex and improves the balance of payment, when imported inputs are to be obtained or the profits are repatriated. Repatriated means whatever the profits you are earning, you are sending back to your own country. It causes the adverse effect on the host country's balance of payment, or he says whenever the imported inputs are to be obtained. Now, Mr. X sets up a business in India, but to manufacture that product, he is importing the goods. So whose balance of payment will be hit? The India's balance of payment will be hit, because for the imports, you will be paying, sir. Right? Sorry. It can also lead to the currency depreciation. Such instabilities hamper the long-term economic planning, lower level of jobs because of the capital intensive nature, then distort the production pattern, right? Activities of the profit-oriented investors are likely to result in the distorted pattern of production. The production could focus on luxury items, offering the higher profits instead of necessities. Now, Mr. X comes to India, wants to invest in India, but the motive is only and only profit earning. So he says, I will make the luxury goods. I will not make the necessity goods. Why should I make the necessity goods? Luxury goods, higher profits, right? So where the luxury goods otherwise demand will be less, it will distort the production pattern, because in a country like India, we say that what is more important? The manufacturing of the necessity goods is more important than the luxury goods, right? Adverse impact on the domestic firms, just read it. I have already told you. Lower standards, efforts to converge the labor and environmental standards in the host countries to international standards fail to receive support from the concerned self-interested parties. That is again, he says, why I will teach the labor? I will not teach labor. Why I should be concerned about the environment? No, sir, I will not be. Because what is the motive? The motive is only profit earning. Adverse effects on the terms of trade. If the FDI is used mainly for the production of export goods, the larger export volume result in lowering the export price relative to the import price. Now, if they are setting up in business in India, so that whatever they manufacture, they send it back to USA, right? What will happen, sir? In that case, the bulk will be in the export prices will come down because there is demand, there is bulk production of the goods. This has adverse impact on the country's commodity terms of trade. Clear? Dual economy means two types of economy will be set up, two types of mental setups will be there. One is Indian, one is USA, American. So that might create the problem, right? Loss of sovereignty. Loss of sovereignty means whatever the individual features of India are, they might be lost because now you are bringing the thought process of someone from the outside, right? You can just read other problems or cost. Then other problems or cost is no genuine interest in the host country's development because the only motive is what? Profit earning. They will exploit the resources of the host country, environmental damage, anti-ethical practices such as aggressive advertising that result in the market distortions. The local market, the domestic market might get badly hit. The national securities consideration, especially in case of sphere hostilities, misuse of excessive power by the investors for their own benefit. Now, investor will say, I have invested in your business. I have 40% stake. I have put in your money. I will take my money back from your business, right? So do whatever I say. So this is what? This is the misuse of the excessive power. Clear? So these were some of the benefits and some of the problems of the cost associated. He said the benefit versus cost comparison. Benefit versus the cost comparison. No generalized statement can be made regarding whether the benefits of FDI compensate for its cost. Can't say, sir. It matters from situation to situation. It is necessary to evaluate the specific country situation and FDI proposals considering the several factors. So he says every FDI proposal is to be carefully scrutinized. It is to be carefully studied before inviting the FDI. Various measures are implemented by the host country with a view to improve the benefit cost ratio of the FDI, right? So what are the measures to control the FDI? There are a few measures which the host country can take to control the FDI, right? So that the undue advantage of the host country is not taken. He says domestic content requirement on the inputs, that the host country says, okay, you want to set up in business in our country, okay, set up the business. But in that case, we put up the condition that at least 20% of the input should be from the host country. Everything will not be imported. At least 20% of the inputs in your finished good should be from the host country itself. The reservation of key sectors for the domestic firms, that a few sector, no sir, you cannot do the FDI, right? That is reserved for the domestic sector. You cannot do the FDI. You cannot do investment in that particular sector. You cannot start a business in that particular sector. Then the requirement of the minimum percentage of the local employees. He says whatever the number of employees will be in your firm, at least this much percentage should be the local employees from the host country. Ceiling on the repatriation of profits, that if you are earning, let's say 1 lakh rupees, you cannot send more than 30% to your country. The rest you have to retain here itself. Maximum 60% profits can be sent back to the home country. The rest 40% have to be retained in the host country, so that if everything is repatriated, if everything is sent back to their own country, then what is the benefit to the host country? No benefit, sir. Right? So these are the few measures which can be taken to control FDI. After that, FDI in India. See, FDI in India says initially the India was very strict on the FDI. It was not really that liberal, but slowly and slowly at the time of 1991 liberalization, the FDI was liberalized, that okay, you can invest in India. Initially, India followed the import substitution strategy in the post-independence period. The wide-ranging government controls restricted the flow of foreign capital to India. Enactment of Foreign Exchange Regulation Act (FARA) consolidated the regulatory framework with the provisions of up to 40% of the foreign equity holding in a joint venture, that if you want to go in the joint venture, only 40% can be from the FDI. Industrial policy announcements and the technology policy statement adopted moderately lenient attitude towards the foreign investment. Moderately, still the restrictions were there. Then he says the most important change in the investment policy of India occurred when the country implemented the economic liberalization and reforms program in 1991. That was done by Dr. Manmohan Singh. Right? At the time of 1991, we adopted the liberalization, globalization. At that time, he says the FDI is important. If we say that the whole of India can survive on its own money, it is not possible. You need to be liberal, you need to get liberalized with the foreign direct investment. That is important. Then reforms in the subsequent years after that included the measures to liberalize the foreign investment and access to the foreign technology and the funding. The FDI regime was radically liberalized on 20th of June 2016 under the Narendra Modi government. The changes introduced in the FDI increase in the sectoral caps. Sectoral caps means that in these sectors you can invest, in these sectors you cannot invest. In these sectors you can invest up to what limit you can invest, right? The bringing more activities under the automatic route. Automatic route is the route where you do not need the government approval, right? Easing the conditions for the foreign investment. It also included easing the FDI in the following sectors. So just go through with the sectors, that these were the additional sectors which were eased, which were liberalized, in which the FDI was welcomed. Clear? So the next topic is the government measures to promote FDI. What can be the government measures, sir? Automatic approval of FDI, simplification of the procedures, less paperwork should be there, setting up of the Foreign Investment Promotion Board, abolished. It has already been abolished, right? In May 2017, it was abolished. Allowing the use of the foreign trademarks and the brand names, allowing 100% FDI in many sectors, that 100% investment from the outside agency, no investment from the host country. Enactment of the Foreign Exchange Management Act, that is the FEMA. Passing of SEZ Act in 2005. So SEZ Act says in the SEZ, in the special economic zone also the foreign investment can be there. Setting up the special economic zones and backing to the mergers, acquisition and greenfield investment. Promoting the foreign technology collaboration agreement. So this is how some of the few steps the government can take to promote FDI, because see, every one of them understood that without this it is really impossible. Without FDI, it is not really possible to grow. That was the thing. Now, rules for investing in India. Route, currently the Indian company may receive the FDI through either through automatic route, that is without prior approval from the government or Reserve Bank of India, or through the government route, that is with the prior approval. Two routes, one automatic route, second is the government route. Instrument, the Indian company can receive the foreign investment by issue the FDI compliant instruments, that is the equity shares, fully and mandatorily convertible preference shares, and the debentures, partly paid equity shares, and the warrants. If the foreign personnel or the foreign individual or agency, institution, any institution wants to invest, they can invest in these instruments only. These are known as FDI compliant instruments, right? Repatriation or transfer of the returns to the home country, that if you earn the profits, then how much of you can return it to their home country, he says, after deducting the taxes. All the foreign investments are repatriable net of taxes. The taxes you have to pay in India, right? That is why we studied that it will increase the tax revenue base of the host country, because the taxes, you earned this profit here, you pay the taxes here, the rest of the amount you can take back to your country. Except the cases where the investment is made on the non-repatriation basis and where the sectoral condition mentions the non-repatriation, that if there are specific conditions are put that you cannot repatriate the money, you cannot take the money back to your home country, in those cases you cannot take back, right? Moreover, dividend profits net of taxes can be remitted outside India through authorized dealer bank, right? So if there are any dividend profits after paying the taxes, after deducting the taxes, take back. Prohibited sectors in India, the foreign investment is forbidden in the following sectors. One is the lottery business, gambling, chit funds, Nidhi company, trading in TDRs, real estate business or construction of farmhouses, manufacturing of cigars, cheroots, cigarillas, cigarettes of tobacco or tobacco substitute, activity sectors not open to the private sector investment. For example, automatic energy and railway operation. In these sectors, the FDI cannot be there, right? These are exclusively the government sectors, right? Because why sir? Because these are really sensitive sectors. If they start getting, let's say gambling is there or lottery business is there, if they start getting the foreign funding now, these businesses will flourish like anything, right? Which are not good for the economy. These are really sensitive matters if you look at from the economic point of view. That is why these sectors, in these sectors, the FDI is not allowed, and in these sectors, the government keeps their control more. Then is the overseas direct investment, ODI, by the Indian companies. What is overseas direct investments? Now, Till now, what we have been taking the example that Mr. X from USA wants to invest in India. Now I say, I am sitting in India and I want to invest in USA. Then what about that? That is known as overseas direct investment by the Indian companies, right? Now the investment is not flowing inward, outward, sir, outward. If the Indian companies want to invest in the foreign countries. So here we are with the last topic of this series of economics for finance, last topic, sir. And I'm really glad that as promised that I will complete it by March end. We are on time completion, absolutely on time completion, right? The Indian companies have also invested in many nations across the world. Yes, sir. Why not? We have the money. We can invest the money. What is wrong with that? The purpose of ODI is mainly driven by three motives. One is the resource seeking. That means if one country has good resources, why not invest in that country and see what resources are available. Market seeking. If a product can be manufactured in India, which has a market outside, why not make a product there with the resources and capture the market. And the technology seeking motives, right? Examples, resource seeking ODI, the Adani investing in the coal mining facilities in Australia because there are many coal mines are there. Resources are there. The market seeking, TCS, Wipro investing in countries like USA and China because they see the IT market is quite good there. The technology seeking ODI, that is the overseas direct investment. Infosys investing in the USA for technological reasons, that USA has a good technology, right? Why not invest? So rules regarding the ODI: at present, the Indian investor can make the overseas direct investment in any bona fide activity except in certain real estate activities, right? There has been progressive relaxation of capital controls and simplification of procedures for the ODI. RBI has relaxed the norms for the foreign investment by the Indian corporates by raising the borrowing limit, that you can borrow more of foreign exchange and you can invest more in the outside countries, right? So relaxation has been there, the liberalization has been going on. The annual overseas investment ceiling to establish the joint venture and the wholly owned subsidiaries has raised to US dollar 1,25,000 from US dollar 75,000. It might have been increased even now, right? I think so. We'll check and update, right? Then he says the current scenario, the outward FDI from India to US was US dollar 1.86 billion in June 2016. We'll have to check the latest stats. What is the latest stats? Such investment from India witnessed a significant change in terms of the size, geographical spread, and the sectoral composition over time. And I tell you, this is important from examination point of view, from the theoretical point of view. The ODI can be asked, right? What are the rules? What is the purpose of ODI? So it can be asked, right? So guys, with this, we end this whole syllabus of economics for finance. So as promised with all of you, that we will complete on time. We will complete by the end of the March. I know some of the students must be having the doubts at that point of time that, sir, we started on 16th of January, this journey we started with, and sir, we have completed by the end of March this series, the whole series, English series, which we called it as the Excellency Batch. Thank you to all the guys who trusted in us, who trusted in this, who have been watching the videos, who have purchased our books. So thanks to each one of you guys. Thanks to each one of you for having the faith that yes, sir, if you are saying you will be completing this series, I'm really happy that we have completed it. Now, we have done our part. Now it's your part to be done, that how you prepare for the subject, how you attempt this paper, right? This is really, really important. And one small message for all of you, that guys, please support your KSJ family. Keep spreading a word about KSJ family with all your friends on all your social platforms wherever you can, right? Because this is the only channel providing the full lectures free of cost. Full lectures of economics of finance is there, financial management is there, cost accounting is there. So please do support us. And one more thing, all the best for your examination at this last moment. Now, what happens near to the examination, a lot of people think that I should be skipping the attempt. I'm not really confident about my preparation, so can I skip? Please don't do that blunder mistake, right? Just give it your best shot. Whatever the time you have, whether you have 1 month or whether you have 1 week, you still have the time to do something which you can do. So do whatever is in your hand and give it your best shot, right? So see you guys very soon. All the best for your preparations. God bless you all. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.